So let's go ahead and get started. I will look at the PowerPoints from Chapter 8 briefly. Let me go ahead and share my screen with you so you can see exactly what I'm looking at. Once we are done discussing a certain topic, I will go to Connect, where I'll work a couple of specific problems. So the first thing that you guys need to be familiar and comfortable with when we're discussing long-term assets, you need to understand their classification. So according to your book, according to everything that we've studied, long-term assets are classified as tangible assets and intangible assets. And that's important because we depreciate tangible assets, we amortize intangible assets, and we deplete natural resources. So when it comes to long-term assets, you need to know how to classify them first and foremost. So you have tangible, anything that has physical substance, such as land, buildings, machinery, equipment, furniture, vehicles. Anything that has physical substance is considered a tangible asset. Tangible assets are depreciated. So we'll talk about depreciation here shortly. Tangible assets are depreciated. All of them are depreciated except for land. We don't depreciate land because land doesn't have useful life. This is something that you guys have to remember. Intangible assets, those are assets that do not have physical substance. Examples include patents, copyrights, trademarks, goodwill. Those assets, if they have a finite useful life, they're amortized. Only the ones that have useful life. Last but not least, under this category of long-term assets, we have natural resources and natural resources are depleted. So again, it's important for you to distinguish whether the asset is tangible, intangible, or a natural resource, because that would determine the treatment. Are we calculating depreciation, amortization, or depletion? So from an accounting perspective, we need to account for several things. The first thing we need to account for is the asset acquisition. The asset acquisition is the point on the timeline when the company buys the asset. This is the first time the company will account for the asset. So this number one accounting stop, so to speak, is at year zero or period zero of the useful life of the asset. When we acquire the asset account will be debited and the method of payment, such as accounts payable or notes payable or cash, will be credited. So in order for us to record the asset purchase or the asset acquisition, we need to know how to calculate the asset's acquisition cost. So for those of you who have watched the recorded videos, you know that the acquisition cost is not just the purchase price of the asset. Let's see what else is included in the calculation of the assets acquisition cost. So I'm going to skip a few slides. Let me go ahead and share this with you again because I think it got unshared. I'm going to skip a few slides. I'll go straight to the PowerPoint slide, which describes what do we include in the asset acquisition cost. We start with the purchase price. So let's look at some of the tangible assets first. Look at machinery and equipment. The purchase price is our starting point. For that purchase price, the company is allowed to add every single thing they incur to prepare the asset for its intended use, such as installing, assembling, and testing. This is a cost the company has to incur before they can start using the machinery equipment. Taxes, transportation charges, insurance. There's a reason why the company is allowed to lump up those costs together. And that reason is, once you capitalize the asset, it stays on the balance sheet at that cost. Very similarly, when we calculate the acquisition cost of a building, we start with the cost of purchase or construction, and to that we add all other costs the company has to incur to prepare that building for its intended use. For example, and I use this example a lot because it is a perfect example you guys can relate to. When TCC purchased their Trinity River campus, which is downtown Fort Worth, from Radio Shack, they bought the whole campus, they paid cash, but then they had to incur millions of dollars in addition to that cash purchase price to convert office buildings into usable space for instruction. So they had to convert cubicle open spaces into classrooms. The cost of that remodel and renovation is allowed to be lumped up with the cost of the building itself. So I hope you guys understand what we're trying to do here. We are trying to give the company a little bit of room to increase the cost of an asset, because once that cost of the asset is calculated, that becomes value of the asset on the balance sheet, which stays there until the end of the asset's useful life. So let's go ahead and look at a problem. Let's go to McGraw-Hill Connect, and let's go ahead and look at a problem which will help us calculate the acquisition cost of an asset. So we're working chapter 8. I'm not sure what this is. Let's get rid of it. So chapter 8, and I'm going to look at the in-class practice problems, which is right here. I'll be working those as a student. So let's find the problem that deals with calculating the acquisition cost of an asset. Also, I wanted to give you a heads up. I'm having all kinds of technical difficulties. So if for some reason, inexplicably, you stop hearing my voice or you stop seeing my screen, I'll try to get back online immediately. But if I don't, I'll try somehow to contact you and explain what happened. I think I'm just needing a new laptop, which ACC will replace. They'll replace my old laptop at some point this week. Okay, so here we go. When we're calculating the cost of a plant asset, remember what plant assets are. They're machinery, buildings, equipment, all the things that are tangible. So in this case, Kegler Bowling, they buy Skorky equipment. The invoice cost is $190,000. So the $190,000 will absolutely be included in the a value in the cost, in the acquisition cost of the asset, at that cost, we need to add all the other costs that the company has to incur to prepare the asset for its intended use. For example, before anything's to happen, they have to deliver the equipment. So this should be included. The electrical work also should be included because the asset has to be installed to be used. Sales tax is included because you have to pay it to purchase the machine. Repair costs, however, are not included. They're excluded because these are normal costs that the company has to incur during the useful life of the asset. So whenever we look at the costs that we just went over, we will debit machinery. You can see where my cursor is right here. $227,000, $227,700, and we'll debit expense. One will go on the balance sheet. The other one will go on the income statement. The big number, the 227 over here, will be depreciated over the useful life of the asset. So this is the very first issue when we account for long-term assets. We need to be able to place the asset, to calculate that acquisition cost, and place the asset on the balance sheet appropriately. All right, so this is the first thing that I wanted to talk about. Second thing that I wanted to talk about is, you heard me mention the word capitalizable costs. So capitalizable costs are all the costs that would go on the balance sheet. Expense costs are all the costs that would go on the income statement. All right, so we're back to the accounting for long-term assets. We discussed the very first issue, which is the acquisition cost. So the first issue, we said we need to calculate the acquisition cost. This happens at period 0. When we find out what that acquisition cost is, the asset will be debited, and then the method of payment, just like I said last time, whether it's accounts payable, notes payable, or cash, will be credited. So this is the first, and I'm going to draw my timeline here. Let's say the asset has a 5-year useful life. 1, 2, 3, 4, 5. Number 1 happens here at the very beginning, at period 0. Then, at the end of every year of its useful life, or every period of its useful life, the company will have to depreciate the asset. So when we are depreciating the asset, this would be accounting issue number 2. We have to figure out the method of depreciation. And then we have to prepare the journal entry. So there are 3 methods of depreciation: straight line, units of production, or activity. So some books refer to this method as units of production, others refer to it as units of activity, and the last method is the double declining, or the accelerated method of depreciation. So once we pick one of these depreciation methods, at these points, 1, 2, 3, 5, we will be preparing the following journal entry. We'll debit depreciation, the depreciation expense. So we'll debit that, and we'll credit accumulated depreciation. So a couple of things that you guys need to know here. Number 1, the Depreciation expense is an expense account, and as such, it will decrease net income. It will also decrease stockholders' equity. Accumulated depreciation, you are familiar with. Accumulated depreciation is a contra asset account. It reduces the value of the asset account on the balance sheet. So let me show you something, and then we'll continue with the problem on Connect. So here is what I wanted to show you. The asset account, whatever that may be, if it's a tangible asset account, will be assigned an accumulated depreciation to go with. Remember, the asset accounts increase on the debit side, decrease on the credit side. Depreciation account, accumulated depreciation account, which is a contra asset, will do exactly the opposite. It will increase on the credit side and it will decrease on the debit side. Let's say we have an asset that was acquired at $100,000. Let's say this asset is depreciating over a 5-year period. So every year we will see a credit to the accumulated depreciation account of $20,000. So essentially, we'll be reducing the value of the asset on the books. When we fully depreciate the asset, we will have $100,000 in the accumulated depreciation account, and the asset account will have a book value of 0. Book value is the asset value minus accumulated depreciation. So at the end of the useful life, asset minus accumulated depreciation should be 0. All right, so now let's talk about the several different depreciation methods. Earlier, I told you guys that there's 3 different depreciation methods that we'll be using in this class. The first one is what we call the straight line depreciation. The second one is what we call the units of production or units of activity. And the last one is the declining balance. Regardless of what method we'll use, we will always need several pieces of information to compute depreciation. The first piece is the acquisition cost of the asset. The acquisition cost of the asset is what the company paid for the asset, plus all the necessary and reasonable expenditures to acquire it and prepare it for intended use. A few minutes ago, we discussed how to calculate the cost of a plant asset. In addition to the cost, we need to know what the salvage value of the asset is. Some books call the salvage value residual value. Either way, what salvage or residual value mean is how much does the company expect to receive for the asset at the end of its useful life. And then, of course, the useful life of the asset. This is how long the company expects to keep this asset and use it to produce revenues. So before we can prepare any journal entries, we need to practice real quick how to calculate depreciation. So I'll get out of the PowerPoints and I will go back to my whiteboard. So here's how we will compute depreciation for the different methods. For straight line, we'll basically take the cost, the acquisition cost of the asset, subtract the salvage value, and divide by the number of units or number of years, number of months, number of periods in the useful life of the asset. So when we do that, this calculation will give us the annual or monthly depreciation expense. Okay, so this is the first depreciation method. Honestly, Dave, this is what we're talking about in this. So Dave's question is, would this be the same way Kelley Blue Book determines the value of cars? I think this is just an accounting calculation. I think Kelley Blue Book would take different information into account. So in addition to, salvage value, the useful life, take into consideration things that in accounting we don't necessarily care for, such as, does the car look good inside and out? How many miles does the car have? So I think it's a little more complicated than what we use in accounting. And I think it's probably a combination of methods. So like the second method, unit of production, units of activity or production, they might use that as well, because think of a car. It has a cost, it has salvage value, and then we divide the number of units. Depreciation expense, Janelle. Anyway, the number of units, which for a car could be the number of miles. So we depreciate here based on periods, here based on units of production, which again, miles are the unit of production for a car. So it answer Dave's questions, I don't really know. It's probably a lot more complex than we know. All right. So do you guys have any other questions? So let's go ahead and practice these two depreciation methods. So I am going back to, I don't know, you can, I don't think that you can see my screen. Hold on just a second. So here's my screen again. I'm going back to McGraw-Hill. This time, I'm going to be computing annual depreciation expense. So because you guys will be given problems like that on the exam, I want you to understand the information that you're given. So for any depreciation, you need to know what the acquisition cost is. So in this case, the Matthews Band, they pay $65,800 for sound equipment. Well, that's what we will use as our cost. $65,800 will be the cost. The $2,000 here is the salvage value. That's what the company expects to sell the equipment after 4 years. They expect to use it for 4 years. So that would be the useful life. So when we are calculating straight line depreciation, we will take the $65,800 and then we'll subtract the salvage value. We call that the depreciable cost. Whatever that number is, we will divide by 200 concerts. I'm sorry, we'll divide that by the 4 years. So we will take the cost minus the salvage value divided by the useful life in periods, in this case years. That would give us the depreciation expense. So here's the actual numbers. We'll take $65,800, subtract the $2,000, so $63,800 is the depreciable cost. We'll divide that by 4 years. So the depreciation expense per year, let me calculate that real quick, 63,800 divided by 4. So every year of the useful life of the asset, the company will depreciate or lose $15,950. Does that make sense? So this is the straight line depreciation. The straight line depreciation, just like I did on the whiteboard, we are using the useful life in periods. In this case, years. So earlier, I noticed this. I looked, at this number, concerts. Well, this is really not a useful number here when we're calculating straight line depreciation. It is a very useful life for the it is a very useful piece of information for the next problem that we'll be on. So for the units of production, we need to figure out what the depreciation per concert is. So when we are working with the units of production, I'm going to share my whiteboard again. The second depreciation method, if you remember from just a few minutes ago, is the units of production. So the units of production method will take the cost of the asset minus the salvage value, just like we did with straight line depreciation, and we will divide that by the number of units of production or activity. The problem that we're working, the units of production activity really are the number of concerts this company is, this band is performing. So similarly here, I'm going to start with $65,800, which is the cost of this asset, of this concert equipment or sound equipment. Then I'm going to subtract the $2,000 salvage value and divide that by the 200 concerts. So when I do that, $65,800 minus $2,000, the depreciable cost is $63,800. When I divide that by the 200 concerts, I can see that the sound equipment will appreciate at a rate of $319 per concert. So every time the company plays a concert, they will depreciate $319 of the equipment. And Dave, going back to your question, that's why I said maybe the way calculated is a little more complicated. It's something like this, right? The more you drive your car, the more value it loses and the less value it has remaining. So maybe it's just a combination of methods. So anyway, the company also, we're told they played in the first year 40, let me just make sure, 45 concerts. So 45 concerts times $319. In the first year, this company will depreciate $14,355. So all I have to do now is I have to go to Connect and plug in the numbers just to get used to using their formatting. Now, units of production is slightly more complicated method than the straight line depreciation because it has multiple steps, right? First, we need to figure out the rate. How much do we depreciate per unit? In this case, per concert. And then we have to apply the rate. So once we know what that rate is, we need to multiply it by the number of units per given year. So if I go back to Connect right here, I know that the depreciation concert is $319, 45 concerts for the first year, so 14,355. Oops, sorry, 45. It already calculated it for me. So 14,355 is the depreciation that I'll be reporting for the first year. So one more thing, let me go back to my white screen. I'll go ahead and delete this. I want to show you something. If we are using straight line depreciation, I am to put it on a graph. The straight line depreciation will look like this. So under the straight line depreciation, we depreciate the same amount every period of the asset's useful life. However, if we're using units of production, it may look something like this: units of production. The reason for that is because the company will be utilizing the asset differently in every period of its useful life. So I'll share my screen again. So let's go to this was the problem in Connect, where all I did, I'm using the formula for units of production depreciation, cost minus salvage value equals divided by total units of production, and these are the calculations that I just did on the whiteboard. All right, so let's look at another problem. I'm going to skip the double declining for now. Let's look at what happens when we deplete natural resources. So the reason why I wanted to look at this problem now is because natural resources are not depreciated, they are depleted, but when we deplete natural resources, we use the units of production method. And because we just finished our discussion on units of production, I felt that this is really a good spot for us to look at natural resources. Natural resources could be mines, it could be oil and gas deposits, it could be timber, it could be silver mines, coal, anything the company in the process of production depletes. So in this case, the Perez company acquires an ore mine at a cost of $1.4 million. They incur additional costs of $400,000 to access the mine, which is estimated to hold one. Let me see what the question is here. Let me pause for a second because there is a question. The question is, does this only apply to non-renewable? No, Dave, interrupt. These are important questions that you're asking. So yes, depletion only applies to natural resources, and by definition, natural resources are non-renewable. So as the name suggests, depletion, we don't expect the natural resource to be restored. So when I'm looking at natural resources, I just like plant assets, I have to calculate the acquisition cost of the asset first. So in this case, I'm told that the company bought the mine at 1.4 million, and then it incurred more costs to access it. So I'm going to say that the cost of the mine is 1.8 million. This is the combination of these two items, right? Cost itself and then the access. The mine is expected to hold 1 million tons of ore. These are the units of production. So this is the units of production or the units of activity. We also know that the estimated value after would be $200,000. So the salvage value is $200,000. The difference between the two, so if I have a cost of 1.8 and 200,000 is salvage value, the 1.6 million is the depletable, just like depreciable. This is the amount that's subject to depletion. We have a capacity of 1 million tons of ore. So when I take the 1.6 million and divide it by the 1 million capacity, that would give me the depletion per unit. Remember, the reason why we're working this problem now is because the depletion is calculated by using the units of production method we just covered. So this is the first step. We just calculated the depletion per unit. This is the rate at which the mine will be depleted. So once we figure out what the depletion per unit is, then we'll look at what units are produced and sold during the first year, which is 180,000. So the depletion expense should be 180,000 times 1.6, or $288,000 for the first year. So this is the depletion expense. Just like depreciation, we'll report depletion expense on the debit side, and we will reduce the value of the mine on the credit side. Okay, so that's depletion. Let me see if I wanted to do something else before we go back to the PowerPoint presentation. All right, let's talk about the last of the depreciation methods, and that would be the double decline method. So I'm going to switch over to my whiteboard again. Hey, Janelle. So let me answer your question before we proceed. Depletion is the units of production method. So we calculate the rate first, and then we apply the rate to the number of units. So I don't know which extra step are you referring to? Okay. Thanks for chatting. Quick question. So actually, it's both. For depletion, Janelle, I'm answering your question. So for depletion, you will still develop the rate. The rate is the first step, right? So the rate is the cost minus the salvage value divided by the number of units. So for the mine, we have the cost, the salvage value, and then we divide it by the 1 million ton of ore. And the rate, what was the rate? I already forgot. Was it 1.6? I think it was 1.6. This is the rate, 1.6 per ton. And then we applied the rate 1.6 times 180 ton the first year. So we did both steps. All right, so let's talk about the last depreciation method. The last depreciation method, so this is number 3, is the double declining. So this is an accelerated method of depreciation. We try the depreciation of an asset in the first years, while the asset is considered very efficient, brand new, and it contributes more to revenues than in its last years of useful life. So for the double declining method, we will first compute straight line, rate, and then second we'll double it. So for example, if an asset has a useful life 5 years, every year of the useful life will be depreciating 20% of its value under the straight line depreciation. Under the double declining, we'll be doubling the rate to 40%. Again, we do that because we assume the assets are more efficient, they contribute more to revenues early on in their useful life. So because they bring more revenues, they also should be associated with higher depreciation expense. So this method is the only method that does not use salvage value. It uses book value instead. So let's see how it works. I'll go ahead and share my screen with you. So here's my screen again. Let's look at this problem in the practice set. This is the double declining method. And this time the company acquires a building at a cost of $830,000. The estimated useful life is 8 years, and the salvage value is $75,000. So in this case, if we were calculating straight line depreciation, then every year of its useful life, the company would depreciate 1/8. 1/8 is 12.5% of the value of the asset. So the 12.5% is the straight line depreciation. If I double that, I'll be depreciating 25% of the value of the asset every year of the useful life of the asset. So again, remember that this is the only method that does not use salvage value. So we will disregard this item. On January 1st, when they purchase the asset, this is what the book value is, $830,000. We're ignoring the salvage value. So for the first year, we have 830,000 times 25%. The first year's depreciation expense will be $207,500. Now, remember earlier today I showed you how to calculate book value. The book value is the beginning minus the accumulated depreciation. So the book value at the end of the first year becomes the book value of at the beginning of the second year. So I'm going to continue the calculation. 622,500 times 25%. The second year, the depreciation expense is $155,625. Book value is calculated again for me. So the next period, the third year, I'm going to have the 466,875. And I'll continue the calculation with the 25% rate. So third year, 466,875 times 25%. I have 116,719. And I'll continue my calculations until the end of the 8 years, eight years right here, which will fully depreciate asset. So one thing before we finish the lecture for today, I'm going to go back to my whiteboard. Earlier I told you guys the accounting issues right here at the beginning. This is the acquisition of the asset. Then we have depreciation. What happens at the end of the useful life? We call this retirement. When we retire an asset, we need to look at several different things. Are we getting anything for the asset? Are we collecting cash? If we are, cash will be debited. Accumulated depreciation will be debited also to close it. The asset account will be credited to take the asset off the books. And if we have a loss or a gain, they'll be either debited or credited to show that the company benefited from the sale of the asset or retirement or not. The lectures that I have already posted for Chapter A, they're pretty detailed. So I suggest that you listen to the first part. Really goes over acquisition costs in a lot more detail than we did today. The second part goes over the depreciation methods in a lot more detail than we did today. If you guys have any questions, ask. Don't. Have a good weekend, and I'll see